Welcome back, traders and investors. At the request of Violin Maker here in the chat room, we have Gil Morales on the Gilmo Report. Gil, how you doing today?
Great.
Okay, just give us a brief, background in the markets and your education.
I'm a graduate of Stanford University, and I went to work for William O'Neill back in 1997 when he recruited me from Payne Webber, where I had been working as a top producing broker. Prior to that, I had started at Merrill Lynch in Beverly Hills, but I went to work for O'Neill, where I was the chief market strategist, an internal portfolio manager running the firm's money. We didn't run client money; we just ran our own money. Vice president and manager of the Institutional Services Group, which was the group at O'Neill responsible for advising, at the time, over 600 institutional investors, and that would include some of the biggest, most successful hedge funds, mutual funds, pensions, bank trusts, etc., out there. So it was actually a good experience. I did that until 2005 and then went off on my own. Tried running a couple of funds, but I found that running other people's money really isn't my thing. I'm a trader. I made my fortune as a trader, trading my own money and trading O'Neill's money, which was like trading my own money, and have found that, having clients, all they do is whine and complain, and I'm much better off keeping my psychology basically untouched and uncontaminated by the psychology of others, namely clients. And so I just trade my own money now and author two websites, virtueofselfishinvesting.com, which is for short, selfishinvesting.com, and the Gilmo Report, which is a twice-weekly report that I write and give my thoughts on the market.
Okay, so just going back over the last 10 years here, you probably have had some favorite and least favorite markets. Could you just I mean, we've had a lot going on over the last 10 years here, and could you just touch on your favorite and least favorite markets in that time period?
Well, I really enjoyed the 2001 market, and I didn't enjoy what happened during 2001. But it was very interesting in my perspective because I was actually getting short the market in late July, early August of 2001. And of course, we know that about a month later we had 9/11. But what's very interesting is at the time you were already seeing a bear market taking hold, and a lot of stocks were setting up in short sale setups. And so I was just hitting those left and right, and I was basically fully short, about 150% short on 9/11. And then on that day, as everyone remembers, they shut the markets down for a week.
Oh, yeah.
And the next week, the market came down about 1,000 points on the Dow, and I was able to cover all my short positions and then shift to stocks like Lockheed Martin, for example, which I remained long well into 2002, even though the market topped in 2001 in January of 2000. January of 2002. We had a little bounce off the September lows in 2001, and you ran up, and then the market rolled over in January of 2002, but Lockheed kept on going higher. And so it was very gratifying to own a position in a stock that wasn't exactly a can slim type of stock, but it was playing on the what I call the big stock principle, in that institutional investors understood that the U.S. was going to a war footing, and so they had to be weighted in that area. The interesting thing is that a lot of defense stocks were also setting up in bases, believe it or not, just prior to 9/11. You sometimes have to wonder if the market's mind, the mass mind of the market, didn't know something ahead of time. So that was a very favorite market of mine. Another one was 2004, where I was long basically Apple and Google, and that was the first time that I employed a technique that we call a buyable gap up. A lot of times you'll see a stock gapping up hugely after earnings, and people won't go after it because it looks too high, but we actually studied these. My partner, Dr. Chris Katcher, who has a PhD in nuclear physics from Berkeley, has studied these, and came up with a very precise way of handling them as buy points. And they're actually, viable gap-ups are actually low-risk buy points, and they're aided by the fact that they have a contrarian component in that when people see something gap up, so an example would be Tesla the other day gapping up to around 210, 215 after earnings, and nobody's going to buy that, of course, because it's too high, but it's actually quite viable. And we actually were adding and buying into that move pretty heavily last week. And today you see the stock trading about 231, so it's going higher. Percentage-wise, it's only another 6%. But I used that on Apple for the first time, and that stock had went from about 43 when I jumped on about 350,000 shares of the stock right there. And by the end of the day, it was trading in the 90s, so it's a very gratifying move. The other stock was Google, where I was first able to use a a pattern that we call the IPO U-turn, where a stock will come public, form a little U sort of shape over the next, say, 5 to 6 weeks or longer, and then turn around and break out and go higher. And so I had those two stocks, and I was
Wow.
up somewhere around 83%, I think, for that year. So it's a very, very gratifying year. My least favorite was 2009. And that was primarily because I was shorting the market and actually doing okay up until the March-April time frame. And at that time, I had lost a lot of faith in the stability of the financial system. And I really thought, having analyzed bank statements and financial statements, 10Qs, 10Ks, and whatnot, I realized that they're all basically insolvent. And so I was certain at the time that all of these things were going to zero, and that we would see at least a couple of the big money center banks, Citigroup,
Mm-hmm.
Morgan Stanley, Goldman Sachs, somebody, where you're going to see more of them go under. And so I remained short those for way too long and got hit on the short side. But the lesson that I learned from that was that shifting away from a technically based methodology, which is normally what I use, I was trying to get way too fundamental, and I missed the technical signals of a bottom during that period and what was actually a great rally off the lows. And so I would have to say that's my least favorite. But there's a little twist there. I think it's my most favorite because I think I also learned a great deal from that particular period.
Going back to that 201. Now you said you came in short, and I remember.
2001? Yeah.
Yeah, I remember that. Remember that day, trading day vividly. We opened up sharply
Yeah.
lower, but there was like a patriotic rally that was just a rip roaring rally, and I remember taking the longs and then flip it short on that. Did you cover that day, or is that you just kind of
You
that
mean on
was?
the actual 9/11 day? Well, they never opened the market on the day of
Well,
9/11.
no, I meant the week
So
later.
they opened
Yeah.
it up a week later, and the market actually sold off for the next 4 to 5 days. And then once you got to the end of that week, the market had a really sharp rally. That might be what you're remembering from that point. And like you, flipping from short to long, that's exactly what I did right there. So it's almost like too perfect, and it's a strange feeling
It's weird.
being able
Yeah,
to
it
use an
is.
event
It
like
is.
that. Pardon me?
I said it. I mean, when you're it's weird when you nail something like that to be that right. You're kind of like thinking, that this can't happen. But yeah, those are some
Oh,
some
yeah.
volatile times. But I mean, you work with Bill O'Neill here, okay? And so you
Right, I
learned
worked with Bill for 8 years, right.
yeah. I mean, from one of the best. What's the most important trading lesson you learned when working with Bill?
Well, one of the things that finally struck me working with him was one day I remember him calling me up and he said, "Look at this AOL," and this was in '98, I believe, towards the end of '98. And AOL was having America Online was having a big move, and he says, "Yeah, that's we own a lot of that." He says, "That's a big stock," and it suddenly struck me, also being involved with advising these big institutions. It struck me that when you're in the market, you want to be involved in the big stocks, the stocks that institutions have to be weighted in, simply because they are the cutting edge of whatever is going on in the economy at that time. And examples today would be stocks like Tesla. They're at the cutting edge of what is really cutting edge technology, the electric car, and taking it to a new level. Netflix, which is taking the content. Entertainment content to a new level with their service. Facebook, which is another thing altogether, social networking. Companies that are doing things that are central to whatever's happening in the economy at that point in time, and because of that, institutional investors have to be in
Yeah.
those stocks, and those are the big stocks, and that's where you want to be. Jesse Livermore referred to those as the leading issues of the day. That's where you wanted to be, and he would say that if you couldn't make money in the leading issues of the day, then you're not going to make money in any particular market environment if you couldn't do that.
Okay, yeah, that's trading the leaders and the big caps. That makes sense. So, tell us about the Gilmo report.
Well, I just write a couple times a week. I try to keep it relatively simple. It's designed for people who don't want too much noise. And basically, I outline twice a week what I'm seeing in the market and the state of leading stocks. I look at thematic drivers, fundamental drivers, and basically try to bring my nearly 25 years of experience to bear in assessing what's going on in the market for my readers. And I would say it's been very successful. I started in 2008, and we're still going strong. And on top of that, I have the other website, which is selfisheinvesting.com, which is more of a real-time alerts service that I do with my colleague, Dr. Chris Catcher. And we're letting people know when we see stocks that are having pocket pivots, which is a proprietary buy point that we use, as well as the viable gap-ups.
Is a pocket pivot, is that related to the traditional pivot point, or is it something do you
No,
extrapolate off
no,
that?
not really. A pocket pivot is it can either be an early entry point. So you'll actually see pocket pivots show up within a base or a consolidation. So it's giving you an early buy point within the base. And I remember picking these up, these sorts of buy points. I'd seen them intuitively, subconsciously, whatever you want to say, on the charts. But Dr. Catcher, Chris, actually codified the whole system of what constitutes a valid pocket pivot. When you're seeing a stock, let's say it's in a base, and it's moving tightly along, say, a 50-day moving average, sometimes maybe in a 10-day moving average, and it'll get really quiet, the volume will die down, and then you'll see a little pickup in volume. And if that volume is higher than the largest down volume over the prior 10 days, and the stock is moving up and off of the 10-day or the 50-day moving average, that will generally define a pocket pivot buy point. And so that gives you an early mover advantage versus buying breakouts. Because what I've noticed is that as people, giving credit to O'Neill, who came out, who was the first guy to really be able to print charts automatically on a plotter printer and have that information available. Back in the 60s, nobody had that at the time, so it was a big innovation. But today, everybody's got charts. Everybody sees breakouts. And I think breakouts are less effective buy points. A lot of times they'll fail, and then you'll see something like a re-breakout where stock will then shake everyone out and then break out again. And I think that's because everybody sees them. And so to get an advantage by buying within the base, I think gives you a leg up on the competition, and is a huge improvement over just buying the base breakouts themselves.
Do you have any recent examples of a pocket pivot off the top of your head over the last couple
Yeah,
days?
actually, if you look at Netflix yesterday, had a pocket pivot. And see, the other thing, a pocket pivot, as I was saying, there's two types. There's the one within the base, which is an early buy point, and then there's one that you use as a continuation buy point. Now, O'Neill's rules about adding to positions is, you buy the breakout, and then if it goes up so many percent, you add this much, and if it goes up another so many percent, you add this much. In this market, you'll see stocks break out, run up a few percent, and then boom, come right back to the breakout point. And my observation is that that can often leave you underwater. You've averaged up into a position as the stock's moved a little bit higher, and then a stock comes in very quickly in this type of environment, and you're underwater. And so you need to have a more concrete buy point to be adding to. And so the continuation buy point, pocket pivot buy point, gives you a very concrete way to add to your position. So, for example, Netflix had a Bible gap up, I think, after earnings. Was it last month, I believe? Yeah. And it's moved higher since then. And yesterday it came up and off of the 10-day moving average if you look at a chart. Hopefully your listeners have access to charts right now. But you can see the volume pickup yesterday was slightly above average, but the stock came up and off the 10-day moving average, and the volume was higher than any down volume over the prior 10 days. We saw a similar move. So you could be adding to your position. We saw a similar position, or actually buy point in Facebook 3 days ago, as it came off the 10-day moving average on what was a pretty good spike in volume right after they bought the WhatsApp.
Yep.
Yeah, I like the name of that. WhatsApp. And so that's where you'll see them. Others, I'm trying to find some others that were good examples. If you look at, say, Yelp, when it was in the base right around the, way down there actually, right around, say, the 65, 66 area back in December, you can go back and look at that area. It's running along the 10-day and the 50-day moving averages, and it had a pocket pivot. It had a couple of pocket pivots in there. You can see a stock like Workday right around, let me see here, I think it's right around the 80 level possibly. Let me see this. Yeah, right around the 80 level, it had a couple of pocket pivots right along the 10-day moving average back in December as well. And these are actually early entry points because these stocks have moved higher
quite a bit,
since
yeah.
then. Yeah, and so you could get in much earlier.
So you sound
Definitely.
obviously very, very technical, but do you
Yeah.
throw the fundamentals in there at all? I mean, it seems like the fundamental
Well,
trading.
Yeah, because you have to put it together with what I call, what the big stock theory is all about. So I'm always looking for fundamental drivers, thematic drivers, and I think fundamental thematic drivers. The difference there is, typically O'Neill says with canned firm you got to have 5 quarters of earnings up, 20% or whatever, and I think that's a little bit dated at this point. I think everybody has access to all that information. The market is a little more forward-looking, and if you look at some of the biggest winning stocks over the last few months, take a look at Tesla. It started out its move way down in the 40s last year, and it had no earnings, basically. You look at Yelp. Yelp is losing a penny or two, and that stock's had a huge move. Look at a stock like Workday, WDAY. That stock's had a huge move, and they're losing money. Look at a stock like Data, Tableau Software. That stock's had a huge move, and they're losing money. Look at a stock like FireEye. It's had a couple of quarters of decent earnings, but for the most part, it doesn't fit the model. Where O'Neill wants to see 4, 5, 6 quarters of strong earnings. So what comes into play there is looking more at other factors, like what is the potential for their market share, what's going on with their technology, how does that establish them as a leader, and basically where do they fit in what's going on in the overall economy. So an example, if you look at a stock like, Workday is involved with the cloud services, and the cloud is becoming bigger and bigger. FireEye, for example, is involved with network security, which is a huge issue, and getting bigger all the time now that Apple's announced that they're subject to being hacked into. And Tesla, of course, the electric car. You look at a stock like SolarCity, that was a huge winner last year, and they're losing money. But if you understand what they're involved in, helping to build these supercharger sites that Tesla uses to provide free charge-ups to their customers, you start to see the thematic basis behind some of the moves here and the forward-looking view that the market's taking. And I think that's dominated the old O'Neill method of looking at past earnings over the last few quarters. Everybody knows that. It's old information. So if you're going to get an advantage, you have to kind of be a little forward-thinking, and then technicals will lead you to where you need to get to, because the market is essentially a mass mind, and you use that to your advantage by watching what the market does and the individual stocks in terms of their price-volume action, because that's telling you what the investors are thinking in terms of where they're putting their dollars based on their best assessment, and it's the mass of investors doing it. So essentially it's a mass mind, and the technicals clue you into that.
Along the way.
And so I'm highly technically oriented, but there has to be a fundamental or thematic driver that I can get my hands around, get my head around, in order to have some conviction. I think Tesla, for example, looks a lot like General Motors of 1915, for example. And thematically, if you look at General Motors back then, the automobile back in the 1900s, Henry Ford came out with the Model A or the Model T, whatever, very utilitarian, and it wasn't until General Motors came out with the V8, the production V8 engine, where you now had power, and they combined that with styling, and suddenly you had a consumer product that caught everybody's imagination, and the automobile took off from there. If you look at Tesla, what have they done? They've actually improved on the whole concept of the electric car, because one of the glitches I always thought was, how do you charge these things up if you're on the road? And so they've sort of rethought the whole idea of creating these supercharger sites that their customers can go to and charge up in like 20 minutes, 30 minutes while they have something to eat or do a little shopping, whatever. And so, they're sort of rethinking it. We wrote an article in Forbes.com last year in June, and we pointed out the similarities on the technicals, believe it or not, of General Motors back then and Tesla today. And we hypothesized that Tesla would have a big move like General Motors did. General Motors went from about 32 to like 80, 90, so basically tripled. Tesla had a big move from around 40-something up to 194, and then it corrected. General Motors, after running up to 80, 90, it also corrected for several months and built a base, and then when it broke out, it went from about 80, 90 to 500. So what we see now is Tesla's just breaking out of its first real base since it had its move last year. And in similar fashion, I think stock could go well beyond 300, maybe even to 400 or 500 from here. if the comparison to General Motors holds up.
Wow, that's impressive. You must be talking to your buddy at Morgan Stanley to slap the 320
Right,
price
they
target onto the.
upgraded the stock today with a 320 price target. So
Yeah. Well, Gil, we got the $1 million question for you here today. The S&Ps, I mean, I think we're just at such a critical level here. Had all that resistance in the mid 1840s. Finally
right,
busted through it yesterday. Get me in. Grandma was taking money out of her mattress, buying another breakout. We trade up to 1856 and change, and we sold off, closed, right at that old breakout area. Are we looking at a
right.
breakout here or a fake out? What would you use to determine if this is really going to be another leg up in the market?
The stocks themselves. In fact, I don't pay attention to the indexes. I think they just lead you around by the nose. And I've seen some charts out there, people trying to compare today to 1929. But, the underlying conditions are not the same. And the indexes seem to be fairly volatile. And there has been a pattern of 5 to 7% corrections. The market suddenly turns back to the upside. We break out and make a marginal new high, and then the market will correct again. And maybe that does happen again. But I'm not going to concern myself with that because I'm going to be buying the stocks and watching what the stocks are doing rather than focusing on the market, what the market is doing. An example would be Facebook had a Bible gap up to the 60 level, right smack in the middle of the correction, and it's continued higher. It's now above 70, and so you had to be buying that buy point right in the middle of the correction, and on the day that the market bottomed out, which I think was about 3 Mondays ago, Facebook actually pulled back a little bit, but never violated that 60 gap up level. And it just continued higher. So if I tell people, just put up on your quote screen, try this as an experiment. Just put up the stocks that you like and that you're watching that either you own or you want to buy, basically that you're keeping an eye on. And just put those up on a quote screen, nice big ones, so they're in big letters so they really come out at you. And just watch those. Don't watch what the market's doing.
Okay, man, I could keep you on here forever. Do you have another minute or two?
I do.
Gold. Gold rallying with the market here. That's not supposed to
Yeah.
happen.
Well, I think you're getting more of this correlation in assets that we were seeing maybe a couple of years ago when gold had its big move. I think there's a realization that QE, is quantitative easing, is here to stay, and that the Fed is going to continue. But they're still buying $65 billion worth of bonds every month. They still have interest rates near zero. So there's a huge amount of liquidity in the system. You're starting to see the money supply is actually, the chart I've looked at of the money supply recently is making new highs. So you have all this liquidity in the system. I think you're starting to see some inflation, so gold is kind of tipping you off to that. But I think what you're seeing is an inflation in assets here that is being driven by the realization that QE is here to stay, and so it's dragging up commodities as well. And so we're getting more of a correlative effect with the commodities and the stocks moving together, which is what was happening back in, say, 2011, 2010, 2011. And so I think that's what gold is telling you right now.
Okay.
I've been long physical gold, since it was around 300, so I'm still holding. I think it's
You're
higher.
still holding. Okay, and just to end the show, what are some of the common mistakes new traders make? And along those lines, what are your tips for new traders?
Well, I think the big mistake I make is not understanding that it requires a lot of work, and you have to study the market assiduously and be on top of what's going on in the economy. You should be pretty well read in terms of understanding what's going on in the economy and understand that it requires some effort. It's not like, you can't approach it like you're a weekend gambler going to Vegas and you're going to make some easy money. You have to apply yourself and find a method that suits your psychology, whether it's value investing, which is good for people who are patient. I'm a very aggressive trader, so I like a technically based momentum sort of method, and stick to it, And I would say also learn to rely on yourself. It's great to subscribe to websites and learn from others, but ultimately when it comes down to the decision making, learn to do it yourself and to do it confidently enough that you don't feel that you need to rely on others to reinforce what you're thinking. You're going to make mistakes, learn from your mistakes, and move forward. And most of all, remain optimistic at all times because, as I like to say, the opportunity of a lifetime in the markets can happen every 2-3 weeks if you keep your head up
Yeah,
and you're aware of it. So
Okay, Gil, thanks a lot for coming on. Gil Morales of the Gilmore
My pleasure.
Report. I worked with, the best with Bill O'Neill, giving some good insights into the market. Thanks for taking time out from your busy day. We certainly like to have you on again.
Definitely.
Thanks, Gil.